Hi, the title of this presentation is Comparing the Financial Performance of US Mobile Network Operators in light of 10-K Annual Reports of 2023. In this episode, we're gonna discuss the story of Adam, and then we will move to some financial terms, important financial terms. We will talk a bit about US Securities and Exchange Commission, and we will explain after that the concepts of goodwill and goodwill impairment. Are you ready? All right. So let us start with Adam. This is Adam. Adam dreams is to have a restaurant. He would like to start his own restaurant and he would like to give it the name Happiness Restaurant. Adam has 60,000 US dollars. Adam did the math and found that the restaurant would cost him 100,000 US dollars. So there is 40,000 US dollars deficit. So Adam borrowed 40,000 US dollars from the bank for 4 years. Now Adam has all the required money to start his dream project. So Adam started the project and everything started well and going well. Daily sales was 2,000 US dollars. So yearly sales was 2,000 multiplied by 365 days equal 730,000 US dollars. Yearly expenditure was 600,000 US dollar. This is the summation of all expenses such as salaries of staff, rent, electricity, water, furniture, vegetables, meat, chicken, everything. So yearly profit equal yearly sales minus yearly expenditure equal 730,000 minus 600,000 equal 130,000 US dollars. All right, in light of story of Adam, let us explain some of the very important financial terms and concepts. At the beginning, Adam has 60,000 US dollars. The restaurant would cost him 100,000 US dollars. So this is the event and this is the financial term or concepts. This 100,000 US dollars, we call it the capital of the project. Adam borrowed 40,000 US dollars from the bank. This is a long-term debt. We called it long-term because it is for more than 1 year. If it is for less than 1 year, we would have called it short-term debt. Now Adam has 100,000 US dollars, consists of 60K or 60,000 own money plus 40,000 borrowed money. This is the capital structure. Simply, the concept of capital structure is how the capital is structured. 60K or 60,000 of it is own money and how much of it is borrowed. Now let us switch to a very important equation, which is assets is equal equity plus liabilities. In this case, 100,000 US dollars is equal 60,000 plus 40,000 US dollar. Basically, at the beginning of the project, this is, we call it or we explain it in financial terms as assets is equal equity plus liabilities. Liabilities are all amount of money that owned by the project to others, and equity all owned assets or money owned by the project, and the total is called assets. Daily sales was 2,000 on average. Yearly sales was 2,000 multiplied by 365 equals 730,000. This is revenue. This figure is called revenue. Yearly expenditure was 600,000 US dollar. We call it in finance expenditure. I would like to go back to this equation one more time. Adam will use this amount of money to purchase equipment, to purchase meat, chicken, whatever he needs to start the project. Okay, so equity is all he owns from different asset, equipments, stock, even food ready to be sold. While liabilities, all the amount of money that he needs to pay to others. It could be to a supplier, or it could be to the bank. Back to this equation, yearly profit is equal yearly sales minus yearly expenditure equal 730,000 minus 600,000 equal 130,000. This is the net income. Net income is equal revenue minus expenditure. At the beginning of the project, as we said, assets is equal equity plus liabilities. 100,000 equal 60,000 plus 40,000. At the end of the year, let's assume that the only change happened to the project is revenue, expenditure, and net income. So the new equation will be 60,000 plus 40,000 plus 730,000 minus 600,000. In other words, using finance, we could say assets is equal equity plus liabilities plus revenue minus expenditure. So 60,000 plus 40,000 plus 130, which is 730 minus 600,000. Assets is equal equity plus liabilities plus our net income. At the end of the year, so 100,000 plus 130 is equal 60,000 plus 130. This is the new equity. Plus 400 or 40,000. This is the liabilities, assuming that there will be no change to the liabilities. So the new equation will be 230,000 plus 190 or 190,000 plus 40,000. Again, for simplicity, I assume that the liabilities will remain the same and all the net income will be converted into equity. But Adam might decide to pay back some of the money borrowed by the bank. So liabilities might decrease and maybe equity could decrease as well, and eventually assets could decrease as well. So this is the concept of capital, long-term debt, capital structure, assets is equal equity plus liabilities, revenue, expenditure, net income, and the changes on this equation is assets equal equity plus liabilities plus revenue minus expenditure, or asset is equal equity plus liability plus net income. Let us talk about US Securities and Exchange Commission, abbreviated as SEC. SEC is an independent federal agency created in 1934 in response to the stock market crash of 1929. It's an independent in the sense that it's not controlled and governed by any political body in the United States of America. Federal, meaning to say that it is on the country level. It's not related or governed by certain state in US. Listed companies are required to submit or file certain predefined reports which SEC allow public access to it. Listed companies are the companies which are listed in the stock market, meaning to say those are the companies which their ownership are on the stock market. Anyone can buy shares on them or on it. The other type of company, which is the private equity. Those are the companies which are not listed in any exchange market. So if you'd like to have an ownership on those private equity company, you need to directly approach the owners of those companies and then talk to them directly. So all listed companies in the United States of America are required to submit and file certain predefined reports. Then SEC allow public access to those files. Anyone can access those files through the internet. This is for investors to have clarity on the status of those listed company for the sake of transparency. What are the types of filings, or what are the type of files that those listed company are required to submit? Number one, annual reports, also called 10-K, and this is the section in the law of SEC. That's why it's called 10-K. Quarterly reports, 10-Q. Current reports, 8-K. This is to report the significant events such as mergers or CEO changes. Registration statements, S1 and S3. This is filed when companies go public or issue new securities. So this is the file that need to be submitted when the company shift from private equity to listed company or go through the IPO, initial public offering, or when it issue new securities. proxy statements, Diff 14A, contains information for shareholders meetings such as executive compensation. Let's now shift to the concept of goodwill impairment. So what is goodwill impairment? To explain the concept of goodwill impairment, let us go through the story of Peter. We all love stories, right? So this is Peter. Peter is a rich billionaire. Peter wanted to buy McDonald's series of restaurants. He loves McDonald's. Peter approached McDonald's owners. McDonald's owners mentioned to him that the cost for the whole series is $70 billion. Peter did the math and found that the identifiable assets would cost him $40 billion. Meaning to say, Peter calculated all the assets he knows about McDonald's, such as the land, shops, stocks, rights, contracts, everything. So there is a difference. There is a $30 billion difference. Peter asked McDonald's owner about the $30 billion difference. McDonald's owners responded that this is the added value of McDonald's brand. Basically, they said to Peter, you are correct. The identifiable assets would cost you $40 billion, and you can use that $40 billion to launch your own series right away. But it won't be McDonald's. This is point number one. Point number two, they said to him, Peter, when you buy McDonald's, you're not only buying the shops and the lands and the machines. You are buying the relationship of McDonald's, the trust people have on McDonald's, the reputation of McDonald's, the image of McDonald's. So Peter got convinced and he bought the series. After 1 year, Peter did the math one more time, and he found that the value of the series is only $50 billion. 40 billion identifiable assets as it is, plus only $10 billion of goodwill. So Peter lost 20 billion of goodwill. 30 billion in the past when he bought the whole series, minus 10 billion. This loss is called goodwill impairment. Goodwill impairment equal book value minus market value. Book value is the value of purchase. Market value is the current evaluation or the current value according to the market. So this is the concept of goodwill impairment. All right. This is the end of this episode, but in next episodes, we're going to talk about the risk factors reported by US mobile network operators in 2023. We'll start with Verizon risks, Then we will shift to AT&T. Then we will shift to T-Mobile. After that, in the next episode, we will talk about financial statements submitted by US mobile network operators for 2023. We will talk about the financial statements of Verizon, income statement, balance sheet, and cash flow. We'll shift to AT&T, check the income statement, balance sheet, and cash flow. Then we will shift to T-Mobile. We'll talk about income statement as well, balance sheet, and cash flow. The last episode will be for comparing the financial ratios. We will check the profitability financial ratios for all companies, Verizon, AT&T, and T-Mobile. We will shift after that to liquidity financial ratios, risk, leverage, solvency ratios, and finally other ratios. This episode is prepared and presented by me, Muhammad Assir. I'm doing MBA at Denver Business School, Heriot-Watt University. I did MSc in Electronics Engineering with a specialism in Telecommunications at SOST, BSc in Electronics Engineering with a specialism in Telecommunications at SOST, PMP, ITIL 4 Strategic Leader, and ITIL 4 Managing Professional. Thank you very much for your time and see you the next one.